Russia.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. It's the last week of October as we get ready to wrap up the month. It's also a big week for earnings. A lot of the big mega cap names out this week, so that's going to be really kind of driving the market. We've got a little bit of economic data coming out this week, but primarily it's going to be the mega cap earnings that are driving the markets this week. Of course, this week also will mark the end of about 80%-ish of the S&P 500 earnings by the time we get to Friday. But Thursday is, of course, Halloween. Big shopping day, of course. Everybody's out buying candy, and it's interesting. Our neighborhood is all decked out, right? It's all decorated. Whoever came up with the 12-foot skeleton made $1 million. They are everywhere. It's like, let's go to Home Depot, buy a 12-foot skeleton. So they're everywhere in our neighborhood. So
it's probably a Karankawa Indian.
Well, whoever came up with it,
Yeah.
they did. They made a lot of money with the 12-foot skeleton. So. And what's funny is that our neighborhood is you walk around the neighborhood, and it's like some houses have, Trump Vance signs, and some houses have, Harris Waltz signs. And what's happening now is that they're all getting very creative. So they have these 12-foot skeletons all over their yards, and they're dressing them up in, either Harris Waltz gear or in Trump Vance gear. And like every day they come out, you know the whole, elf on the shelf thing that people do.
Yeah.
Well, they're now doing that with these skeletons. So like one day you'll drive down the neighborhood and they're all like holding cups and wearing their hats and drinking coffee, and then the next day they're waving or doing something else. So every day, some poor husbands have to go out there. The wife's going, go out there and change the pose. So
Somebody has too much time on their hands.
probably it's not me. We've got ghost dogs. That's what we've got. So anyway, so that's going on this week. Unfortunately, if you live in Houston, it's supposed to rain this week. So rain on Thursday and Friday, 80% chance. So plans may damper, but we need some rain. It's been a very, very dry October in Houston, so we need a bit of the rain. But again, unfortunately, it'll come on Thursday. But unfortunately, that just means I might have more candy to dispose of, at my house. My motto is when the kids come home, check the bags for Reese's peanut butter cups. Those are yours. Forget those kids.
That's right.
Anyway, but by Friday, we'll wrap up the month. So we'll be starting the month of November, as we've talked about before. That's basically the buyback window opens back up in November, and then we'll have November, December. Of course, this is where we'll get a lot of the retail sales data coming out. So again, while the typical bias is to the upside, November 1st starts the seasonally strong period of the year. Out of all 6-month periods of the year, November to April have the strongest levels of returns historically than any other 6-month period. So, November to April is stronger than January to May, as an example. So again, a lot of these kind of big drivers into the end of the year, positioning for taxes, positioning for performance chasing, year-end window dressing, stock buybacks, of course, is all potentially kind of drives markets higher. So again, the market should have a tailwind going into the year. But again, as we've said, this election could certainly throw a wrench into that. A contested election, something that doesn't get done. And we're going to talk about in a second. We talk about before the bell. There's some positioning that's going on that could also be problematic for markets. So the point here is that while you have a lot of tailwinds into the end of the year, there is risk, as we've talked about previously. There are some things that could go wrong here over the next month. They could throw a wrench into the start of the seasonally strong period. So again, we have to continue to manage risk. We can't just ignore it. The bias historically is to the upside, but certainly things can go wrong. Remember 2018, the Fed said basically in September, is like, we're nowhere near the neutral rate, and the market declined in October, November, December 20%. So it doesn't guarantee, just because it's a seasonally strong period of the year, that's not a guarantee that markets will go higher. Just the wrong word, the wrong positioning, a different outcome of the election can certainly change that dynamic. In fact, let's talk a little bit about that. Here's what you need to know before the bell this morning. So a couple of things that are going on. And again, the markets right now have started positioning for an election winner. What we don't know for certain is who that winner will be, but the market is predicting a winner for this election, and we can see this in a lot of the actual trading that's going on in the markets, positioning in certain groups of companies that would benefit from policies that of the president elected that would agree with the policies that they might implement. So let's talk about a few of those. So first of all, the S&P continues to kind of grind its way higher. Really, ever since about September, the market's been on a very nice trajectory, just traveling along this 20-day moving average. Again, that's historically, that 20-day moving average acts as a really good kind of running trend line support for the markets. So when markets are running up, it gets a little too deviated from the 20-day, you get a pullback to that support. And markets have been holding on to that for the last couple of days. Futures are pointing positive this morning. So after a bit of a little sell-off on Friday, we came down, retested that 20-day moving average again on Friday. We're going to bounce off that again, at least at the open this morning. We are on a sell signal, though, which is kind of limiting the upside advance. So again, that's not surprising as well. So we're kind of working off some of this overbought condition. We're on a sell signal, which is limiting the upside. So again, we're kind of in a little bit of a consolidation right now for the markets, not really making much of an advance. But again, there's nothing really kind of going on here. Now, the market's kind of just to the point right now where they're just kind of holding their breath, waiting to see kind of the outcome of the election, which is now just right around the corner. But as I said, the markets have been positioning for an outcome that they think is going to be the winner. And right now, that looks like to be the market is betting on President Trump for a couple of reasons. One, if Trump gets elected, he's promised that he would institute tariffs, which, of course, if I'm a foreign country, I want to get ahead of that. So we've seen very strong flows into the U.S. dollar, storing of reserves. Basically, tariffs would lead to more revenues into the U.S., which, as revenues come into the U.S., that strengthens the dollar. So a big trade here has been, as of late, to get ahead of those potential tariffs by buying the U.S. dollar or buying assets that relate to the U.S. dollar in particular. But the dollar's getting pretty stretched here. So again, this is kind of a little bit of a late trade at this moment. You've already had a very big rally. Markets are stretched and overbought on the dollar here near term. So you could expect a bit of a pullback here at some point. But we've also seen relative flows as of late into financials as a good example. Financials have been doing very well under a Trump presidency. He would be more of a deregulator of restrictions on banking. That would potentially do a little bit better for banks. And so banks have had a very nice rally here. Had a bit of a correction on Friday, but again, very nice rally so far. Now, take a look at technology, also same way here. Technologies have actually been doing a whole lot better here as of late. Nice rally really ever since those August lows. Kind of same thing here. So again, here's the risk to all of this. What if Harris wins the election? All of these trades potentially have to be reversed very quickly for whatever positioning that the markets would take at that point. So again, that's the risk of this. The market is kind of betting on the outcome of election. Not surprising, that's what markets do. Markets are kind of anticipatory about certain outcomes, and they have a pretty good track record of predicting who is going to get elected in presidential election cycles. But again, some of these trades are really kind of stretched and far out there, particularly like on the dollar is a good example, and a reversal of that will certainly weigh on asset prices if Harris gets elected. Keep a watch on oil. Oil's having a big reversal today, back down to support here as well. So again, that's due to easing of tensions basically in Israel-Iran. So that's weighing on oil prices this morning. Okay, so that's what you need to know before the bell. When we come back from the break, lots of stuff to get into. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. It is, of course, Monday. Big news in the Roberts household over the weekend. So on Sunday, my daughter came over and wanted to go to lunch, and she needed some help filling out some of her. She's a senior in high school right now, so she's starting to do her work for getting prepared for college. She's been sending out her college applications and those type of things, and so she needed some help filling out some of her scholarship applications and student loan forms and those type of things. Because again, as I've told you, we don't pay for college. They've got to figure that out on their own. And so she came over and she was sitting down and she got an email from one of the schools that she applied to. And she was very nervous about opening this email because it's from Baylor, which is her first pick, which is where she wants to go. She wants to study pre-medicine. And so she got this email and she wouldn't open it. I go, honey, you've got to open it to figure out if you got accepted or not. And she goes, well, you open it. So I opened it and she did. She got accepted to Baylor. So we're very proud of her. And she got a $50,000 merit scholarship. So that helped her also very well. So we took her out to lunch yesterday, celebrated a bit. But yeah, we're very proud of her. It's our youngest and she's just finishing up high school this year. So I have successfully gotten 4 kids through high school and out. So off the payroll. So, and then successfully into college. So we've got them all doing what they're supposed to do and heading in the right direction. So we're very proud of them. Anyway, congratulations, honey. We're very proud of you. Love you very much. Okay. So there's a comment here from in the chat. It says, I live on a private cul-de-sac with 3 houses. Yeah, I live on the corner of a cul-de-sac, and this weekend there was like 4 million kids in the cul-de-sac having Halloween. I don't know why they were doing it on a Sunday this early. I guess all the parents are worried about the rain this weekend.
It was a dress rehearsal.
I guess it was a dress rehearsal, but lots of kids out yesterday. Anyway, so a couple of things to talk about. So as I touched on in the market, kind of the before the bell video, the big, and we talked about this in the newsletter this weekend as well, just kind of recapsulated some of this commentary for you. The markets are betting pretty heavily right now on a predictive outcome for the election. The risk, and again, if everything works out fine and everything is okay and the markets are right, they're positioned for a particular outcome. The problem becomes if something doesn't occur that way, right? If the market gets it wrong. And again, I think as investors, we have to be somewhat cognizant of the risk in this environment that something goes wrong. Either a contest of some sort, lawsuits being filed, whatever it is on the outcome, no matter who it is, right? That disrupts the market. So, this isn't something I think that you start selling everything and going into cash and just, I'll wait till after the election. I don't think you need to do that. But I think we need to be well aware that there's a risk that this recent run we've had in the market, could take a decent break. And again, lots of statistics, as we talked about the month of November and December, seasonally strong period, lots of reasons for it, performance chasing, buybacks, etc. That's not going to matter if the election doesn't work out the way Wall Street thinks, or if there's a delay in the outcome of some sort, or lots of civil unrest, or whatever it is. So I think you have to go into the election, which is just next week, right? The election's next week. So I think you have to go into that election just understanding that there is risk that we're going to wake up on Wednesday morning and all of a sudden this market's potentially down. It could be up massively, right? I mean, if there's a very decisive outcome that's too big to legislate, then this market's just going to rally like a banshee. So again, that's why I think you can't go into this saying I'm just going to be in cash, right? Because the risk is there's a risk of being all in cash, which is this market just takes off running and you can't catch up. So as investors, I think we have to go into this being allocated, but understand that we might have to make some very quick moves on the other side of election day just in case. So I think we have to be prepared for that. One of the things that is the best setup right now, and as I told you last week, one of the sectors of the market that is best set up for an outcome of the election is Treasury bonds. They're oversold. They're very deviated. I took a long position in Treasury bonds. I suspect that yields will fall into the end of the year, regardless of the outcome of the election, but particularly if there's a contest. If there's a risk-off action in the markets, it's going to go into Treasuries. So there's going to be a really good kind of hedge potentially set up with Treasuries into year end. But again, that's why I took a personal kind of trading position. It's a personal bet. I could be wrong. And so I don't encourage you to follow me into things that I do because they don't always work out well. So be careful. But I do think there's an opportunity there that we'll see kind of come to fruition. One of the things that, we also had previously kind of taken profits out of energy stocks, that continues to work out fairly well right now. Energy continues to be under a bit of pressure. I think that we're going to see a decent opportunity to go long energy probably before the end of the year. And that'll also, and again, depending on the outcome of the election, that could be a big driver for energy shares. But energy shares are pretty oversold relative to the rest of the market as well. So my point here is that there is going to be some positioning changes that need to happen over the next couple of months, but we're not going to really know what those are until post-election. So we'll just have to sit tight and kind of navigate through that. Like I said earlier, there's not a tremendous amount of economic data this week. We've got Dallas Fed Manufacturing Index out this morning. The manufacturing side of the equation still remains fairly weak for a lot of reasons. And I'm probably going to rewrite this, rewrite an article I wrote a couple of years ago on the Chicago Fed National Activity Index. It's one of the most overlooked indexes out there that we have, but it's probably the most important. The Chicago Fed National Activity Index has 85 subcomponents to it that cover both manufacturing, services, housing, covers a lot of stuff. But it is really a very broad look at the overall economy and is a really good indicator of where markets and economics will be over the next 12 months. That number continues to remain very weak and actually came in much below expectations in the latest report. So, and again, as I said, I've written an article before. If you go to realinvestmentadvice.com and just type in CFNAI, Chicago Fed National Activity Index, just the initials, you'll get the article and you can kind of read through it, but it needs to be updated with a lot of the data. And really, I wrote that article, I think, back in 2022. But again, and that was kind of during that downturn that we saw in 2022. The Chicago Fed National Activity Index was already telling us that was coming. So it was a good leading indicator into that downturn. It's telling us some of the same things again. And, with markets extremely deviated, markets very optimistic, again, going into 2025, I think there's a big risk of potential disappointment in earnings growth. It's kind of fascinating to me right now. I was actually, kind of putting this out on Twitter this morning, but, the one and again, I'm not saying that analysts and economists are wrong by any stretch of the imagination. They could possibly be right. It's certainly a possibility. I've got a chart up here, Brent. But they're expecting that. So for the last couple of years, almost 100% of earnings growth has come from 10 stocks, right? And there's been basically no earnings growth. There's been negative earnings in 2022, 2023, and really kind of the net earnings growth of 2024 has all come from 10 stocks. There's not been a tremendous amount of growth from the other 490 stocks in the index. However, what analysts are expecting is that that's going to reverse and the earnings for the top 10 companies are going to slow, but the earnings for everybody else is going to pick up. I'm not sure how you actually get there. I'm not saying it's not possible, right? But the bottom 490 stocks are very economically sensitive. So for their earnings to grow you're going to need some fairly strong economic activity going forward into 2025, and you're going to need some drivers for that. Now, that's certainly possible, but if they're growing, the top 10 stocks are going to grow as well. So I'm not sure how you get to the point where you say, well, Microsoft and NVIDIA, they're going to stop growing, and Amazon is going to stop. And that's really the best example. Amazon's going to stop growing earnings, but everybody else is going to do well because the economy's booming. So the economy's booming and people are going to stop ordering from Amazon. It doesn't make sense to me. So I don't know how they get there. I think this is a very optimistic outlook, and we'll see what turns out to be the case. But they're betting on fairly strong economic growth. And the question I think we have to come back and ask ourselves is, in this current environment where we take a look at what's happening with spending and households and what's happening with, kind of living paycheck to paycheck for a lot of families, where that economic growth is going to come from. We'll see. But I think it's something worth paying attention to, at least as we get into 2025. All right, come back from the break. We'll talk a little bit about some of the other economic data coming up this week. Again, lots of earnings coming out as well. We'll get into who's reporting this week also. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife and I are in a huge fight. She says I absolutely don't love her anymore. And I said, honey, that's not true. I just said you can't put the Christmas tree up yet. It's not Halloween.
Does she want one tree or both of them up now?
She wants them both up. We compromised with Thanksgiving stuff on the table and Halloween stuff in the living room.
The Real Investment Show podcast. Same show.
Yeah, I'm surprised she's not wearing her Christmas sweaters yet.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show. So, talking a little bit about this week coming up and the things that we've got going on. It's a pretty action-packed week. Today we've got not a lot going on today, earnings-wise, but tomorrow is Google, both Googles. Don't ask me why there's two Googles. There's two Googles, two different share classes. Both Googles report tomorrow. AMD. British Petroleum, Chipotle Mexican Group, the world's most overpriced burrito. Crocks, which explain to me Crocks, people, right? This was a company on the verge of bankruptcy because nobody would wear the world's ugliest shoes. And somebody came out with a video that says, look, it's got sport mode on it. And Crocks have now taken off again. So they have Crocks for dogs. And trust me, yes, my wife wants to buy them for our dogs. Don't ask me why. It's just a thing. McDonald's also reports this week. It'll be interesting to see what they say about the recent E. coli issue that hit the stock pretty hard the other day. Outside of that, that's kind of the big bulk of it on Tuesday. Wednesday, we have ADP, Caterpillar, Etsy, Eli Lilly, which is in kind of one of the top 10 stocks, Microsoft, Meta, all on Wednesday. So Wednesday will be a big day. Then Thursday is Apple, Amazon, ConocoPhillips, Intel is also on Thursday. Peloton, they should be announcing bankruptcy by Thursday. We'll see. Actually, Peloton should team up with McDonald's. Honestly, there's just, buy a burger and get a class. So there you go. Anyway,
a free pair of Crocs.
And a free pair of Crocs, yes. And then Friday is ExxonMobil. So by Friday, like I said, most of the big, kind of the top 10 will report. Now, we don't get NVIDIA, right, the company, until late November. They're a very late announcer. But we should get a pretty good hint at NVIDIA's earnings with AMD this week. So we'll kind of see what the forecast is. Now, economically, this is also a fairly big week. On Thursday is the core PCE index. Now, again, this is going to feed right into Treasury yields. It's going to feed into the markets as well. So again, if core PCE, as an example, comes in hotter than expected, that's going to really impact the markets. If we see... it's also going to impact markets in terms of expected rate cuts, those type of things. So we'll have inflation data on Thursday with core PCE continuing claims. Obviously, those just continue to remain low. On Friday is the non-farm payrolls. So interestingly, we are going to get employment for October on the very first day of November, and we'll have the employment report basically a couple of days before the election. So we're going to have basically inflation data as well as the employment data going into the end of this week. So again, there's a lot of movement potentially between this week and next week going on in the markets because of the economic data combined with the expectations for Fed rate cuts because of that data, and then the election. Somebody put in the comment that Lance is being bearish this morning. No, I'm just trying to warn you there's some risk out there. That's all I'm saying is like, and again, what's our job? Our job is to manage risk. Like I had a conversation with my dog over the weekend. I was asking what his job was. He was paying no attention to me whatsoever. But I kept asking what his job was. He would refuse to tell me what his job was because I can't figure it out. All he does is lay around and mooch for treats. So our job as investors is that we actually have to manage risk. And again, as I was saying earlier, this is going to be a tough couple of weeks for the markets in terms of positioning for risk management. You don't want to be in cash. Yes, there's lots of reasons why this market could hiccup over the next 2 weeks. Technically, fundamentally, economically, there's more than a sufficient reason to be ultra cautious, right? You could just say, hey, you know what? I'm going to sit aside on cash and I'll come back in a couple of weeks when this is all over. And that might turn out to be good advice. I don't recommend it because there's some things also that could happen that this could send this market, surging higher, and then you're trying to play catch up, trying to get back in. So the point is I think we just have to, process our management into our portfolio. Look at positions that you're very overweight in, reduce those back to target. Things that aren't working, if the market hiccups, the things that aren't working, they're really not going to work if the market hiccups. So trim those out. Raise a little bit of cash. Don't have to raise a lot, but just kind of trim around the edges. We've talked about gardening, and we've talked about how that falls into your portfolio management. This is a really good time to do that because this is one of those periods over the next couple of weeks where the outcome is very cloudy because there's so many exogenous events that it could occur that you really can't price for. Because again, you just don't know what the outcome is going to be. It's just one of those things. I mean, we may go into the election expecting one outcome and then something else totally happens. And then you're positioned on the wrong side of the trade. So again, that's why I'm just saying, I'm not being bearish this morning. I'm not being doom and gloom. I just want to warn you that this is one of those particular times where we have to step back and say we've got to just really evaluate for unknown outcomes and what those might be. So if Lance was Trump, there would be a full court press about how he's lost his mind. I don't understand that iconoclast, but
where did that come from?
But my wife would probably agree with you because she calls me crazy all the time. Trust me. Anyway, so that's just it. This is kind of where we are in this particular cycle and what we're going to have to just kind of deal with over the next couple of weeks. So again, just be a little bit cautious here. Don't take a lot of excess risk. I would not make any real outsized bets on the outcome of the election, those type of things, just simply because there's too many unknowns and the risk reward setup is not great for that. Again, the one thing that I think you can do is buy treasuries here as a hedge. Treasury's gotten really beat up lately. There's not a lot of downside risk here, and there is more in terms of an advantage in terms of hedging risk post-election that bonds will do better for a whole variety of reasons. But on the downside, you've got liquidity, you've got asset protection in terms of the bonds, and you pick up a dividend yield off of, or an interest income yield off the top of it. So there's not a lot of downside risk to buy treasuries here as a hedge for your equities in your portfolio. So again, that's kind of one thing. Now in our client portfolios, we've already kind of positioned going into this. We've already raised cash. We've already taken profits. So if you're listening to the show this morning, you're one of our clients, there's not a lot for us to do here, because we've already been doing it for the last couple of weeks, kind of preparing for this. So we didn't want to be forced into a position that we had to do a whole bunch of stuff all at once. But we're in a pretty good shape. So we still might do a little bit of trimming and pruning here over the next few days. We'll as we kind of get closer to the election, we'll kind of keep evaluating what's working, what's not working in the portfolio, and we'll adjust accordingly. But again, we've already kind of been taking these actions over the last couple of weeks, getting ready for the election. So again, that's just kind of where we are. All right. I don't really want to jump off into another topic just yet, but okay, well, we got about 3 minutes. I guess I'll tee it up. Got 2 minutes? Okay, we got 2 minutes. I can kind of tee up another topic here. So I'm writing an article right now. There was I must have gotten 40 emails from people about Paul Tudor Jones over the weekend. I just got absolutely flooded with emails. Have you seen this video from Paul Tudor Jones? And CNBC did an interview with Paul Tudor Jones, and basically, he said that he would not own Treasury bonds. And again, this is an interesting kind of topic. And so I'm writing an article about it. And I just wrote one recently. So again, there's just been a lot of this lately. James Grant also had made some of the same comments about why interest rates are going to continue to go higher in the future and not lower. The problem that, that both of this analysis have from these individuals, from both James Grant as well as Paul Tudor Jones, is that it's not based on history of what's happening. It's based on kind of media talking point assumptions that are going on about debts and deficits, but not the actual driver of what drives interest rates. And so we're doing a bit of work on that. We'll have an article out on either Tuesday or Friday next week. It just depends on how soon I can get it finished up. But again, it's kind of an interesting position because we hear the same kind of talking points over and over again. But Paul Tudor Jones went one step further and made a comparison about why interest rates are going to rise in the future rather than decline because of a particular impact on U.S. Treasuries and a historical correlation to someone else. And we'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at Real realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just left off just talking a little bit about Paul Tudor Jones. I got this email over the weekend just repeatedly about this interview with Paul Tudor Jones with CNBC. So I'm writing an article about it that we'll have out in the next few days for you as well with all the relevant data. But in that interview, he made a very interesting comparison. Basically, his whole thesis is the same as James Grant, which is debts and deficits will lead to higher rates, and we're on the verge of bankruptcy as a country, and that is a very false statement. You cannot go bankrupt when you can print your own currency. It's you may not like that fact, right? But that is a true fact. You cannot go bankrupt when you can print your own currency. Now, you can have a whole lot of other. I'm not saying that printing your own currency is a good thing, by the way. I'm just saying that you have the ability to pay your debts. What is bankruptcy, right? Bankruptcy is I have debt and I can't pay it. That's bankruptcy. And so the one differential between a household and the government is you can't print your own currency at home. Well, you can, but you would go to jail for it. But the government can print its own currency, so you cannot physically go broke when you can print your own currency. It's just impossible. Now, there's negative outcomes for that, and those negative outcomes are slower economic growth, less economic prosperity, a whole variety of other side effects from that. It's also very deflationary in nature because you're creating an environment with no economic prosperity. Because the more debt you have, as we've talked about before, you erode your underlying ability to grow the economy. And this is where he made the comparison. He said, take a look at Japan, right? I don't think he actually took a look at Japan. Because if you take a look at Japan, and we're doing this analysis in the report that we're writing, we went and took a look at Japan for the last 40 years. Japan is basically their Federal Reserve, the Bank of Japan, has bought about 80% of all the ETFs. They've had just a massive inflow of quantitative easing. The bank balance sheet for Bank of Japan is just absolutely skyrocketed. They have a debt to GDP ratio of 250% versus 120% for the U.S. Now just take that for a moment, right? Just that one aspect for a moment. The country of Japan has a debt to GDP ratio of 250%. They are a country that is 1/3 the size of the U.S. and does not have near the economic resources of the U.S. But we've got people running around, waving their arms, screaming, we're going broke at 120% of debt to GDP? Really? But back to Japan. 40 years. Rolling recessions every 3 years, 4 years, right? The real economic growth in Japan is negative right now as of the last quarter. They basically their interest rate on their bonds, their government long duration government bonds, they're equivalent to our treasuries, are at about 0.85. Now, those interest rates have risen up here a little bit lately off of zero, but not by much. You're still below 1%. Inflation is negligible in Japan. And they have not been able to get inflation or create sustainable economic growth or get interest rates off zero in 30 years because of the debt. The more debt that you have, the worse the economic prosperity and outcome is. So in other words, the lower the yields go. They have to go lower because of your economic growth rate. And so again, we have all these people running around it's like, well, it's the debts and the deficits, but you have to put this into context of what is actually going on with the economy and go back to the fact of what actually drives interest rates, economic growth, wages, and inflation, right? So if you don't have any economic growth, you're not going to have wage growth. And if you don't have wage growth, you're not going to have economic growth. If you don't have economic growth, which creates demand in the economy, you don't have inflation. And if you don't have inflation, then interest rates have to come down because nobody wants to borrow money. So this is all very deflationary in nature, not inflationary. And we've gone through this with you before repeatedly. And again, it's just we keep hearing kind of this bad rhetoric going around from time to time. Now, it doesn't mean in the short term that concerns over the debts, the deficits, those type of things won't move interest rates in one direction or the other, because they will. But there's also a lot of other drivers for why interest rates are moving in one direction or the other. Right now, we've had a big rise in yields because we were extremely oversold in yields previously. Going into September, we'd had a massive run, 4 standard deviations above the mean. You were going to get a reversal. It was inevitable. So here it is. So now you've completely reversed that move, and you're likely going to see a fall in rates between now and the end of the year. Just as rates start to reposition for economic growth. So where's economic growth right now? And economic growth is running around 3%. Interest rates are over 4%. So interest rates will come down to eventually equate to where we are on economic growth. Whereas inflation's running about 3%-ish, a little bit less. Interest rates will come down. They're all going to match over time. Now, the one thing that we've talked about before, and this is incredibly important, is that you have to figure out where your terminal rate is. And we don't know where that is yet. But the terminal rate is where economic growth, interest rates, and inflation all align. And right now, the trend line for that data intersects at about 2.5%. So 2.5% looks like to be the terminal rate at the moment, assuming you don't have a recession or a financial crisis at some point over the next year. So if rates settle in at somewhere between 2.5% and 3%, that may well be the terminal rate for the time being outside of a recessionary event. So as the Fed cuts rates, they'll cut rates back to 2.5% to 3%. That'll align with inflation at 2.5% to 3%. Interest rates will come down to 2.5% and 3%, and then pretty much the bond trade will be over at that point, unless you have a recession. Again, there's a lot. The thing about bonds is you can run around all day long and throw out these historical examples and talk about debts and deficits. Do you realize that the debt to GDP ratio is actually declining? It's not increasing. That the deficit to GDP ratio is actually declining. It's not increasing since 2020. So see, a lot of these arguments that are running around, right, aren't really founded in any type of history. They're great fear tactics, right? But they're not really grounded in how interest rates work, which is pretty much just math. And again, as we talked about before, all bond traders are doing is simply working on forecast for risk, right? Credit risk, inflation risk, interest rate risk, all those type of things. And all they're doing is factoring that into the yield of bonds, whether it's corporate bonds or agency bonds or treasury bonds. It's all a function of just traders calculating forward risk. If I'm going to loan money to somebody for a period of time at a certain rate, I've got to make sure that rate accounts for all the potential risk. So it's just pretty much a function of math. There's not a lot of stuff into it. Now, in the near term, rates will move up and down all based on emotional arguments and theses and those type of things. But in the long term, it's all math. So it's just interesting. Again, I'm going to write an article on this, and there was an article out, kind of around this in the Wall Street Journal talking about a pivotal moment. U.S. economic data will be a mess, right? And economists warn of new inflation hazards after the election. Okay. So they talk about inflation's fallen thanks to a higher interest rate and big assist from healed supply chains and an influx of workers. And now, if based on who wins the presidency, either Donald Trump or Kamala Harris, their policies, threaten to stoke inflation by spending more money in the economy. And that's very true. If they do another big inflation reduction act, and you inject the economy with another, $700 billion, $800 billion, $1.5 trillion, that's certainly going to impact it. The money's got to get into the actual economy. Tariffs don't really do that. Tariffs collect money from foreign countries, goes into tax revenue, gets spent on taxes. But those countries have to try to inflate prices to offset those tariffs. The question is whether or not U.S. citizens will buy those products or if they'll buy them somewhere else cheaper, right? Donald Trump imposed tariffs in 2018. We didn't have inflation to any degree until we shut down the economy and we sent checks to households. Then you had inflation. Why? Well, the tariffs didn't really impact the U.S. economy. It didn't create demand within households because consumers were simply just spending what they had to spend. So tariffs didn't create a big influx of prices or a big increase in prices back in 2019, early 2020. What created the inflation was when you shut down those supply chains, you had no supply, and then you gave people checks to spend. So now you have demand and no supply. So again, we have to always keep these, so it's these are great headlines, right? Oh, inflation is going to be surging back. If we deport, a mass amount of illegal immigrants, that's going to cause inflation. There's really no economic evidence of that. But it's great headlines, right? It's designed to scare you and get you, Wall Street Journal leans very left, so they're trying to get you to cast your vote in a certain manner, and that's okay. But again, we have to go back and look at the actual data. And again, these fears over inflation at the end of the day, if you're worried about inflation, focus on what drives inflation. Don't worry about the headlines. Focus on what drives the inflation and say, do we have an environment to create 5% economic growth, to create 5% inflation, to create 5% wage growth on a sustained basis, which would lead to 5% interest rates? That's the question you have to answer. The rest of it doesn't matter. All right, wraps up the show for the day. Be back tomorrow. John Penn, we'll have an article to talk about in the morning as well. So again, tune in tomorrow. We'll get that. Be sure and smash that like button for us this morning, and have a great day. We'll see you back here tomorrow.